Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about how to pick index funds. And the reason that I wanted to select this topic this week is because it seems like anytime I'm at a cocktail party or a friend's house or out to dinner or something like that, somebody inevitably will ask the question, well, what should I invest in? And inevitably, somebody else across the table, other than myself, will chime in and say, well, you should just put everything in index funds. And I think that's probably great advice for most people, but it's not quite the answer that I think a lot of people are looking for, because the obvious follow-up question is, okay, well, which index fund should I choose? How should I go about picking this? How do I buy it? Should it be this one or that one? Should it be a Vanguard fund or a Fidelity fund or a State Street fund, a mutual fund, an ETF? And so in today's episode, I'm a huge fan of index funds. I do think that there's a slightly better way to invest your accounts, which we touch on in this episode, a slight improvement to index funds. But by and large, I love index funds. I think they're a great solution. And in this episode, we'll walk through a prudent portfolio and investment process and how you can decide and choose how to pick an index fund that's a good fit for yourself. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Okay, so today on the show, on the podcast, we're going to talk about how to pick index funds. And what we talk about today could realistically be applied to other funds that are not technically index funds. But the reason I wanted to cover this on the show is because there's just a lot of chatter out there on the internet and inbound questions that we get. And the question goes something like this. Everybody's telling me that with my portfolio, I don't need to do anything fancy. All I need to do is just buy an index fund, put all my money into index funds. It's a simpler option. How do I go about doing that? How do I go about actually buying these funds? What funds do I choose? How should I think about all this? And so in today's episode, I want to go over exactly how to do just that. From a high-level portfolio perspective, we'll cover our philosophy at our firm, how we think of this in an investment, in a comprehensive investment framework, how to choose which funds you're in, how to choose whether they're ETFs or mutual funds. And then we'll talk about how we make these decisions at our firm and how you can make them on your own as well. So hopefully this is helpful to some of our listeners, because I think, index investing is such a positive thing. It is such a great strategy that's going to work for a whole lot of people out there. And the reason that it can work for a whole lot of people is it's less expensive than other types of investment strategies, and it's a little bit easier to employ consistently by just being invested in index funds all the time, no matter what. You're not trying to buy them before you think the market's going to go up. You're not trying to sell them before you think the market's about to go down. It's a somewhat simple strategy to employ. And for those of you out there that want to manage your own money and just find some easy, no frills, simple way to go about it, this episode is definitely for you. Now, there's a lot to investing, and there's actually a lot that happens under the hood of index funds that I think is often lost on investors in those funds. But guess what? That's okay, because index investing is going to broadly cover a huge, vast investable universe of different stocks and bonds and other asset classes that you might want to put in there. And that's great. I mean, this pursuing an indexing strategy is a great path to a good investment outcome in general. So why don't we start with high level portfolio process? And when I think of this, there are really 4 levels of decisions that we all need to make as investors. This is what we help our clients sort through at our financial planning firm. And the reason that there are 4 levels of decision making is because some of these decisions are more important than others. And there is a whole lot of empirical evidence and academic research and study to back that up. And by far, over and over again, the biggest decision that we have to make as investors is what kind of stuff are we going to invest in? Are we going to invest in commodities like gold and oil? Or are we going to invest in bonds and cash-like products, maybe U.S. government bonds, non-U.S. bonds? Are we going to invest in stocks? Are we going to invest in alternative asset classes like undeveloped land or venture capital or private equity or hedge funds or something like that? Your decision of what to invest in and what portions of your portfolio will be placed in these different asset classes is by far the biggest decision that you're ever going to make as an investor. There have been studies that say that that decision alone is responsible for more than 90% of the returns that you'll ever see. And another way to put that is that your decision of how much of your accounts to put in bonds versus stocks is far, far more important than your decision of whether you should buy Ford or GM or Tesla. Those are all very different companies. Their stocks are going to perform differently. They have performed a lot differently in the past. Tesla has crushed, both of those alternatives handily, but nonetheless, they're both in the same asset class. And that's the exact reason that we have asset classes in the first place. Is bonds are fundamentally different than stocks, and they have different risk and return characteristics and profiles, and that's why we kind of place different individual types of investments into these buckets. Because again, the biggest decision is which bucket are you going to choose for your portfolio. So that's asset allocation. That's the first decision that we need to make as investors. The second decision is asset category. I call this asset category. Other investment managers might have a different name for this, but realistically, we're talking about sub-asset classes within each of these buckets. So of the portion of your portfolio you're allocating to stocks, how much of those stocks are going to be in U.S. companies or companies domiciled elsewhere in the world? How much of those are going to be in developed economies? How much are going to be in what are called emerging economies, less developed economically? Again, just like we have different asset classes because those securities have different risk return characteristics, stocks in the U.S. have different risk return characteristics to us as U.S. investors than stocks in less developed economies around the world. That's why we should separate them into different asset categories. So if your first decision is how much of my portfolio is going to go into different asset classes like stocks and bonds and cash, now the second decision is let's go one level down. Of the portion of my portfolio that's going to be invested in stocks, how much of that bucket is going to be in U.S. stocks, international developed stocks, or companies in non-U.S. countries in more developed economies, and how much of my stock portfolio will be placed in emerging markets. Now, again, different investment managers think of this differently. This is a top-down approach. We're starting high level, and then we're working our way down. Some investors out there, particularly institutional investors and a lot of hedge funds, will take a bottoms-up approach, where they don't really care so much about asset class. They care more about the individual opportunity and merits of a specific company or a specific investment. And that's where you get into all sorts of complicated arbitrage strategies and things that hedge funds do. And that's a completely valid way to manage money, but usually that's reserved for institutional and fund managers who are doing one thing and they're doing it really well. For individual investors like you and me, we might decide that we want to have some of our portfolio in that complicated hedge fund arbitrage strategy, but we probably don't want to put everything there because by and large, you and I are saving for our own financial future. We're saving for our retirement, and we're probably going to need to save up enough money to last us maybe 30 to 40 years in retirement in the future. The institutions that are investing in that hedge fund strategy have a much, much longer window. We're talking about endowments, pension funds. They have time horizons of hundreds and hundreds of years, and that's just a fundamentally different thing than what you and I are investing for. So that's a common reason that other investment managers will start from a bottoms-up approach. What we describe, the reason that we have this philosophy at our firm is because we focus on individuals, and by and large, we're all trying to save for our retirement, and we're trying to grow enough money in our nest egg so that we can stop working at some point. And usually that's not a period that's longer than about 40 years. So asset allocation, most important decision from a top-down approach. Then we go asset category. Again, different investment managers might split up these sub-buckets in a slightly different way. Some people like to go large companies versus small companies at this level, as opposed to U.S. versus non-U.S. companies, for example. Nevertheless, there are subcategories. That's your next best decision. Your third decision down, this is where security selection comes into play. And so the topic of the episode today is how to pick index funds for your portfolio. This is exactly how to do it. But you've got a couple bigger decisions to make first before you decide, hey, should I buy Vanguard's index ETF or State Street's ETF? By and large, they're probably going to be similar, but you have bigger fish to fry before you get to that point. So asset allocation, asset category, and then security selection. So at this point, you should know how much of your overall portfolio you're going to put in emerging market stocks or non-US bonds or US government bonds. You already have those asset allocation and an asset category decisions made. Now comes to, okay, I know that I want, let's say that you're using a 60-40 portfolio, 60% of your portfolio will be in stocks, 40% in bonds, and of those stocks, maybe you want, let's use a round number, half of them in U.S. companies and half of them in non-U.S. companies. So 30% of your overall portfolio will be in U.S. equities. Now it comes time to actually pick the funds that you're going to put into your portfolio. Now this level of decision making is where we have another choice of strategy. Are we going to pursue an index strategy where we just buy everything and sit on it without trying to deploy more of our portfolio to companies we think are going to do better and less of our portfolio to companies we think are going to do worse? Or do we just buy everything, right? So active management is the process of identifying rating those individual companies. So if you use, let's say that the U.S. stock market, the investable universe of U.S. stocks, let's use the Russell 3000, which is a broad-based index of 3,000 publicly traded U.S. companies, and it's one of the major broad-based indexes that are used. So what you might do if you're pursuing an active strategy is review and analyze every single one of those 3,000 companies that comprises the Russell 3000. And if you think that 300 of those 3,000 are going to be absolute dogs and lose money over the next, investments in those companies are going to lose money over the next 5 or 10 years, you might not have anything in them. And you might find, 500 of those companies that you think are really, really great. You might deploy more of the 30% of your portfolio toward those 500 companies than you do the rest of the 3,000 stocks. And some of them you might omit entirely, right? But guess what? Analyzing 3,000 companies is one heck of a lot of work. And that's why it's often better to buy a mutual fund or an ETF that comprises that same universe of stocks. So there are 3,000 stocks in the universe. Why don't we just pay a manager to pick the winners and avoid the dogs for us, right? That's an active strategy. And what we've found through decades and decades of studying this, I say we pretty loosely. I didn't actually do any of these studies myself. I've just followed along as other people have, who are way smarter than me, have produced these studies. What they found is that when you buy the mutual fund, the fees that the managers impose on those funds are not justified by extra returns. Because the alternative to paying an investment manager or a team or a company to analyze those 3,000 companies and pick the winners and avoid the dogs is expensive. It's a lot of work, and there's a lot of professional expertise that goes into that. And the alternative is just buying all of them without scrutinizing which one do you think is going to do better, which one do you think is going to do worse. Just buy the index fund. Buy an index fund that mimics or tracks the Russell 3000, and you remove that layer of cost from the whole equation. And from my perspective, when I look at this, if there is a human out there that can justify their fees by consistently producing more returns after their fees than the index produces if you line them up side by side, then I will happily pay an investment manager a whole lot of money to do that. So if the index returns 8% every year and the mutual fund manager is charging 1.5% for management of his mutual fund, then that fund better do it better have average performance of better than 9.5% for us to incur that. And what the studies have shown is that after those costs, that's not true. Active management is not able to justify the additional cost. And so this is why people have flocked to index investing, because you're more likely to reach a better outcome when you're not trying to forecast which companies are going to do great and which companies are going to do poorly on a company by company basis. Okay. So that's a big decision that you have to make when you get to this third level of security selection. Now, let's say that you've already decided you're going to invest in index funds to build your portfolio, right? If you're still listening to this episode, you've probably already made that decision. So now it comes down to the question of how do you want to represent the asset category, or asset category by asset category, I should say. So if we're looking at that 30% of your portfolio that's going to be in US stocks, do you want to use the Russell 3000? Do you want to use the Wilshire 5000, which is another index that's really popular that index funds track? Which group of companies are you really trying to track in your portfolio? I would argue that you probably want more than just the S&P 500, because those are just the 500 biggest corporations, and there's a lot of return to be had and diversification benefit by going to other corporations as well. But realistically, the Wilshire 5000 and the Russell 3000 are two of the broadest sets that you can use. So if you decide that you're going to proceed and use the Russell 3000 as an index that you want to track in your portfolio, now it comes down to, okay, which index fund do I buy? And for all these these major indices, S&P 500, Russell 3000, Russell 2000, Dow Jones Industrial Average, NASDAQ, all the major stock indices out there, they're structured a little bit differently, but all the major investment managers out there that you'd be familiar with have funds that track that specific index. So Vanguard, Fidelity, State Street, Invesco, Charles Schwab, they all have index funds that track any of those indexes that you want to invest in. So how do you decide between them? Right? This is like this decision of should I use State Street's Russell 3000 ETF or Vanguard's? This decision is far less important, way less important than the decision of how much of my portfolio is going to go into which asset category, how much of my portfolio is going to go into which asset class, stocks, bonds in the first place, And oftentimes I think we get this backwards. We focus so much on, should I buy Fidelity or State Street or Vanguard? Guess what? They're all the exact same securities. What you're looking for in an index fund, once you get to that level, is you're trying to find a fund that has very low fees, both transaction fees and ongoing operating costs. You probably want some stability in the management there. That is not quite as important as it is for active mutual funds, because this is the investment of an index fund from the manager's perspective is more operational. You don't need a whole lot of professional expertise from Fidelity or Vanguard's perspective, because they're simply getting a list of the 3,000 companies that comprise the Russell 3000. And then they're buying everything on that list proportionally to how much money is in the portfolio. There is no decision making from the perspective of the investment manager. The gamesmanship all has to do with execution. When are we going to buy these things? How can we make sure that we get the best price? How do we handle cash needs in and out of the portfolio? So if an investor like you or me sells a bunch of shares and we need our cash back from the investment manager, how are they going to handle that? So you're looking for operational efficiency, low fees, right? You're looking for the size of the fund. So if you're going to line up State Street's in Vanguard and Fidelity's index, Russell 3000 index funds side by side, you want to compare annual operating expenses. You want to compare how much money is already in each of these funds. Generally, the larger, the better, because that manager has more staying power, more viability. And if there are a lot of redemptions in the fund, they're less likely to have to distribute taxable capital gains to you. And then for the case of ETFs and mutual funds, just ETFs, you want to look at volumes and spreads. And this has to do with the trading of, if you decide, okay, I'm going with State Street's index ETF for this portion of my portfolio, then now it comes time to actually buy that security. As we've talked about on the show in the past, there's a big difference in the trading of between mutual funds and ETFs. By and large, most people are probably going to want to choose an ETF these days instead of a mutual fund. A mutual fund, you give cash to State Street, they give you shares of the fund in return. It's not traded over a market or anything like that. State Street takes your cash and then they invest it in the portfolio and all those 3,000 underlying stocks, just like everybody else. But mutual funds are a little bit less tax efficient, and sometimes they're forced to distribute taxable capital gains at the end of the year when you might not really want to receive one. And sometimes these mutual funds come with a commission attached to the buying and selling of them. That is another source of fee that we really want to try to avoid. So for most people, by and large, you want to choose an ETF instead. An ETF is a different animal. It trades over the secondary market. So if you want to buy shares of State Street's Russell 3000 ETF, I could have looked this up preparing for today, but I didn't. It's a quick Google search away. You instruct your broker, which could be at Vanguard or Fidelity or wherever else, that you want to buy X amount of shares of this specific fund. And then your order goes to the market and you buy it from somebody who's selling that fund. So this is where bid-ask spreads come into play and volumes come into play. If you're comparing those three options, State Street, Vanguard, and Fidelity, for the Russell 3000 index fund, and you're looking at ETFs, this is something you want to look at as well, because a bid-ask spread is simply an intangible trading cost to you. To refresh everybody's memory, an ask is what the market maker is asking for shares of this security. So I want to buy 100 shares of this ETF. This is what the market makers who are selling that ETF are asking for right now, if I want to buy it. The bid is what they are bidding to offer to buy it from us if we want to sell. So if we hold shares of this ETF and we want to sell them, the bid is what the market maker is bidding for them. The wider the disparity between the bid and the ask, the costlier it is for people like you and me to buy and sell and transact in these funds. So a fund that has a lot of volume, a lot of shares trading hands every day, a lot of assets in the fund are typically going to have narrower bid-ask spreads. And that's better for investors like you and me because we will get better execution and lower aggregate trading costs when it's all said and done. So again, you're lining these three options up side by side. You're looking at Vanguard, State Street, and Fidelity's index funds. They all three track the same universe of stocks, the Russell 3000. Look at costs. Look at bid-ask spreads. Look at volumes. Look at amount of assets in the funds already. Look for how long those funds have been around, and then make your decision. So again, by and large, the decision of how much of your portfolio is going to go into any of these asset classes and asset categories in the first place, way more important than, hey, do I buy Fidelities or State Streets? Fidelities or State Streets, it's the exact same 3,000 stocks. And guess what? The managers of all those, of each of those three funds are compelled to buy and sell the same stocks at the same time. Every time the list of 3,000 companies from the Russell 3000 reconstitutes, some companies are dropped from the index, they're dropped from the list. Other companies are added to replace them. So guess what the managers at Vanguard and Fidelity and State Street do? They sell the companies that are dropped from the list. They add the ones that they're replaced with. So the composition here, right? What's in any of these index funds? They're identical, and you're looking for a more efficient chassis or operating setup, I guess is another way to put it. Now, along that same line, there is a way to change the methodology of how the indices are built. And an example of that is an equal weighted fund. So you might get to this third level. You might get to the security selection level of your portfolio decision making. You decided on asset allocation and asset category. Now I want to find the security. Well, you might have decided that you want to use the 3,000 companies in the Russell 3000 as your universe of stocks that will contribute to your portfolio. By and large, most ordinary index funds are cap weighted, meaning that they take the 3,000 companies on that list. Excuse me if you've heard this from me before. And the amount of money that goes into each of the 3,000 companies is not equal. It's based on capitalization, which is the number of shares of the company that exist and trade multiplied by the price at which they trade. And so your more expensive companies, your bigger companies, are going to have more weight in the index than the smaller companies. And one popular way to level the playing field there, which is it's been popularized over the last 10 or 15 years, is to replace a cap-weighted index with a simple equal-weighted alternative. And so that might be a viable thing to consider as well. And that is certainly different. That is a different implementation of the Russell 3000 than any of these first three options that we were talking about. Because here you have the same 3,000 companies, but you have the exact same amount of the portfolio invested in all 3,000. Whereas the cap-weighted index is going to be structured with a different methodology. In general, I'm a fan of the concept of equal weighting, but for something as broad-based as the Russell 3000, that's maybe a little bit too aggressive for my tastes. I think if you're going to use an equal weighted index, it makes sense for something like the S&P 500, but you're really kind of the more you go into the investable universe of U.S. stocks, the more radical your portfolio becomes when you're equal weighted, because you have, number 2,999 on that list by size, you have the same allocation to as you do Apple. And that's it can be a little bit dangerous in some circumstances. But again, it's something viable to consider. So that's about all I had for today. Oh, one more thing that I forgot. So there is a fourth level to this. Level 1, asset allocation. Level 2, asset category. Level 3, security selection. Level 4 is asset location. Asset location has to do not with what investment, what asset class you're invested in. It has to do with where are those investments parked. And when I say the words your portfolio, in general, I mean the aggregate of all your investment accounts. And that includes your 401k at work. That includes your Roth IRA. It includes your taxable brokerage account. It does not include the cash you have in the bank. All that's, but all that stuff includes investments generally and is part of your investment portfolio. And each of those accounts that I listed, a taxable account, a Roth IRA, and a 401k, all have very different tax treatments. Now, we talked about this concept of being diversified. Stocks, bonds, cash, US, non-US, each of those different asset categories that we generally want to include in our portfolio have different tax ramifications. Your mega cap US stocks might pay you a dividend. And the dividend's probably qualified and you pay tax at a lower rate than you do interest that accumulates in a bond holding. You might have other, non-US stock and bond funds that pay short-term capital gains that are taxed at a higher rate than long-term capital gains, which is usually what you get out of US funds. So the idea here is if you have a couple different accounts with different types of tax status, that you park the least efficient asset categories in the Roth accounts that you're never going to pay tax on again. And the most efficient asset categories in your taxable accounts that you have to pay tax on every year. Every single year that you get a dividend or a capital gain distribution in a taxable account, you have to pay tax that year. But if you get that short-term capital gain distribution or something else that's rather undesirable in a Roth account, well, guess what? You don't have to pay tax on anything as long as the assets remain in that account. So this level, right, the fourth level, asset location, it's not going to move mountains for you. Asset allocation is far more important, but it does improve. It is very, very clear that it will absolutely improve your after-tax returns if you do this thoughtfully. There is a downside to doing this, and that's that your portfolio decisions get really complex really quickly. We do this on behalf of our clients, but that's because we have a whole lot of really fancy software that helps us add that level of detail and make those buy and sell decisions. But if I were doing this on my own using spreadsheets, which I have in the past, just know that it gets really complicated really quickly. And if you look at just the statement for one of those accounts of your household portfolio, like your Roth IRA, and you have emerging market stocks in your Roth IRA and international developed market stocks, well, that account alone is going to look pretty funky. It's not going to be diversified on its own. But when viewed in the aggregate across all your holdings, all your accounts, that's when you can really look at and analyze performance figures, because that will include a balanced and well-rounded portfolio. But if you have, one account that's filled up just entirely of one asset class, then that's a different story. And oftentimes that happens because, if you're in that situation, let's say that you have a taxable investment account, you contribute to a Roth IRA every year, and then you max out your 401k every year. Well, contribution limits this year for Roth IRAs are $6,500. Contribution limits for 401ks are $22,500. So you're probably going to have a 401k of much larger size because you're putting a lot more into it than you are a Roth IRA. And if you're going through some kind of hierarchy and priority order. That's basically how our software works, is we assign an asset location priority to each category. Then you want to park the least efficient stuff in the Roth accounts first. And you might use up all the balance of your Roth accounts just immediately because you have far less in there than you do in the 401k and taxable account. So that's a pretty common thing that happens. So again, it will help, right? Just to be totally clear, it will help. But I would say if you're going to dip your toe into level number 4, then you need to be committed to it. You need to know what you're getting yourself into, and know that it's going to require more time on your end to manage on an ongoing basis. Because if you do that at the outset, you make all your security decisions, and then you go to that level of detail to maximize your household returns. Great, I'm all for it. It will maximize your returns if you do it properly. The values of each of these securities over the next 12 months are going to move around a little bit, and then when it comes time for you to rebalance, now you have to do all that analysis over a second time to know whether you need to incorporate a different asset class in a different account. It's a little bit easier if you just replicate the same list of securities and the same portions across all of your accounts. So that's my 2 cents for today. I hope this was helpful. You know, I talked a little bit about how we do things here as a firm. I am a huge fan of index investing because I think it leads investors to a better outcome. I am also a believer that there is a superior method to core index investing, and that's really employing a more thoughtful indexing strategy is one way to put it. But because that list of 3,000 companies is being updated for everybody at the exact same time, that means that Vanguard, State Street, and Fidelity are all selling the same stuff and buying the same stuff at the same time, and you just don't tend to get good execution from that. So if you come up with a methodology and a list of securities and a method that you are going to weight those securities that is consistent and it's sound based on empirical evidence and research and so forth, then you have more flexibility on when those securities are bought and sold. And if there's something that you want to add to the list because it meets that defensible criteria, well, if the price moves against you, you shouldn't be compelled to buy it that day. If you want to drop something from the list, you shouldn't be compelled to sell it that day. Just wait until it meets your parameters in the portfolio. And there are companies that do that. Dimensional Fund Advisors is a partner of ours that is really the pioneer of that. We use a lot of those funds in our client accounts. And that's what I use in my personal accounts because they're able to maintain that low-cost approach, broad-based consistency. We're not going to guess what the market's going to do next. We're not going to try to pick the winners and avoid the dogs. We're going to invest in everything, but we're going to allocate the portfolio in a way that's a little bit different than the cap-weighted indexes, but again, based on sound methodology. So I hope this was helpful. I will probably circle back, being the beginning of the year, we'll probably circle back on a similar topic here over the next couple weeks. But until then, I will wish you a good rest of your week.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.